Scienture Holdings, ticker SCNT, is currently trading at $2.60. That is up a staggering $2.03 on the day, a move of 354.94%. Now, when most traders see a percentage like that, especially on a sub-$5 stock, the immediate expectation is that this is a pure gamble, a low-float lottery ticket that's probably being pushed around by chat rooms and algorithms. It's the kind of move that looks chaotic, dangerous, and purely speculative. Many will look at this, perhaps on their Robinhood app or SoFi Invest platform, and dismiss it as just noise, something destined to crash back to earth by the closing bell. The expectation is that this is a mirage, a fleeting moment of irrationality. But the reality today is substantially different. This isn't random. This 350% explosion isn't happening in a vacuum. It's the market's violent, immediate reaction to a specific, fundamental development that just hit the wires. The reality is that the company is experiencing a massive surge in interest and volume related to its recent commercialization efforts. This isn't just a technical bounce, it's a fundamental repricing based on the market's realization that the company is transitioning from a development stage entity to a commercial stage one. Of course, the skepticism is warranted. We've seen this story before countless times. A small company, barely registering on the scanners for Fidelity or Schwab Intelligent Portfolios, suddenly gaps up on heavy volume. The common belief is that these moves are traps designed to pull in retail traders using online investing platforms just before the insiders or early investors dump their shares. The volume is insane, yes, but that volume can disappear in a heartbeat. People look at this and think it's just a signal to stay away, to stick with the perceived safety of Apple stock or a broad Fidelity ETF. They assume that by the time you hear about it, the move is already over. The expectation is that this is a classic pump and dump. But what if the market is actually trying to find the correct price? What if $2.60 is just the start of the repricing? The deeper take here isn't just about the press release itself, but about the float of the stock and the implication of the news. Recent announcements indicate that Scienture has begun commercial sales and fulfilled its first orders for Arbli, its FDA-approved, ready-to-use liquid losartan. This is the first such formulation on the market. When a company with an extremely small number of shares available for public trading, a low float, undergoes a fundamental change from zero revenue to actual revenue from an approved product, the supply-demand imbalance becomes extreme. The reality is that everyone who is short, everyone who is sitting on the sidelines, and every algorithm scanning for news is trying to get a piece of a very small pie, all at the same time. This isn't just speculative froth, it's a structural market collision. We're not just watching a stock trade, we're watching a vacuum get filled. Let's break down the mechanics of what we're seeing on the charts today. The stock gapped up significantly at the open, likely halted multiple times on volatility circuit breakers, and is now attempting to find a new level of price discovery. The volume is the key. We are seeing millions of shares trade hands compared to an average daily volume that was probably in the low thousands or even hundreds. This is what institutional interest, or at least high-speed programmatic interest, looks like. This isn't a few traders using SoFi active investing, this is a systemic repricing. This kind of volume surge is critical. For traders using advanced platforms like interactive brokers, they're watching the level 2 data and seeing the bid-ask spread widen and contract violently. The volatility here means that using market orders is incredibly dangerous. This is where limit orders become essential, whether you're using the Fidelity mobile app or the interactive broker's trading terminal. The spreads might be so wide that a market buy order could get filled 10 or 15% higher than the last traded price. This is a professional's environment, despite the stock's low price. The interactive broker's fees might be low, but the risk from slippage is extraordinarily high. The recent movement is also triggering short squeeze speculation. Any traders who were short SCNT, betting it would go lower or stay dormant, are now in a position of extreme pain. They are being forced to buy back shares at any price to cover their position, adding fuel to the buying pressure. This creates a feedback loop. The news causes a gap up, the gap up triggers short covering, the short covering forces the price higher, which in turn pulls in momentum traders. It's a cascading failure for the bears. This isn't like watching Tesla stock move 3% on a macro headline. This is a violent structural realignment of the company's perceived worth. What about the institutional side? Are Fidelity Wealth Management or other large funds even touching this? Not yet. At this stage, it's too small, too volatile. This is the realm of specialized hedge funds, quantitative traders, and a massive influx of retail traders who are comfortable with this level of risk. This is the kind of stock that lights up the most active lists on Robinhood stock trading and other investing sites. Platforms offering Robinhood fractional shares make it accessible, but the danger is immense. The risk is enormous. A subsequent filing, a clarification, or even a halt could stop this dead in its tracks. But the opportunity is what is driving this 354% gain. The expectation is that this is a gamble, but the reality is a high-stakes bet on a specific, newly announced commercial launch. We also have to consider the macroeconomic environment. In a high-interest rate environment, speculative assets, especially pre-revenue biotech or pharma, often get crushed. But the market is starved for growth stories. When a company successfully gets an FDA-approved product to market, the market is desperate to find the next big thing. Not necessarily the next Nvidia stock, but a solid multi-bagger. They are willing to overlook the immediate financials in favor of a story of market penetration. This move is 100% narrative-driven, but the narrative is backed by an actual product launch. This separates it from a mere rumor. For the average person looking for investment help or starting with an intelligent portfolio, this is an absolute do-not-touch stock. This is the opposite of a set-it-and-forget-it Fidelity mutual fund or one of many SoFi ETFs. This is an active, high-risk intraday vehicle. The skills needed to trade this are completely different from those needed for long-term online investing. You need direct market access, real-time data, and an understanding of market mechanics, the kind of tools offered by the Interactive Brokers platform or the most advanced tiers of Fidelity's trading platform. People who invest online are often looking for these asymmetrical bets, and SCNT is the definition of one today. The psychology of the holders is also fascinating. Anyone who held this stock yesterday, perhaps they bought it months ago in an individual brokerage account and forgot about it, or it was sitting dormant in their Fidelity IRAs, just saw their position multiply by over 4.5 times. The temptation to sell is immense. This creates a massive wall of supply. The battle today is between those original holders and the short sellers selling into the strength and the new wave of buyers who believe the commercial launch makes the company worth even more. This is why the price is oscillating so wildly around $2.60. It's the equilibrium point being fought over by these two massive opposing forces. The volume is the footprint of this battle. We're watching a war between old holders and new believers. So, what is Scienture Holdings? Before this recent string of news, the answer was a micro-cap pharmaceutical company. It operated as a holding company focused on developing and commercializing products primarily for cardiovascular and central nervous system diseases. For months, even years, it was a dormant stock. Its financials were thin, reporting minimal activity, minimal assets, and its entire existence was predicated on getting a product approved and to market. This is why the stock traded for pennies or barely traded at all. It was an option ticket on a future possibility. Yesterday's SCNT was a forgotten entity, a line item in a high-risk portfolio, perhaps held in a speculative SoFi investing account along with other SoFi stocks, but certainly not a core holding for any serious investment strategy. This isn't the kind of holding you'd find in Fidelity Investments' core portfolios. Past performance is almost irrelevant here. Looking at its 5-year chart would just show a flat line followed by today's vertical spike. Older reports, 10Qs and 10Ks, would just show a company burning cash in R&D and searching for an opportunity. The expectation based on its history was zero. The company was, for all practical purposes, a non-entity in the public markets. This is why today's news is so potent. It's not an earnings beat for Apple stock.